Heard it? I love this echo.
Recording in progress.
Everybody remember there's a mic button to press it before you speak for the tape. All right, let's go ahead and go through, let's call the meeting to order and let's do a roll call. I'm Chair Lanza. I'm here. Sunita, are you here?
Yes, I'm here.
Andrew, you here?
Here.
David Kwan.
Yes, I'm here.
Howard Lee. Howard's sick, and I think you said Maytek, he sent an email saying so sick he wouldn't come.
That's right.
Okay, great, thanks. Ashfar, you here?
Here.
Dick, you're here.
Yes.
And then turn over to Maytek. Dave and Franco are at a conference. Go ahead, Maytek.
Are they on the Zoom?
Yeah, we're here.
Oh, great. Okay. And is Franco with you in the same location?
Yeah, we're both here.
Okay,
in the
great.
dark because our hotel has no power, but yeah.
Yeah, we can see you. All right. So I'm going to walk you through some of the traditional Brown Act questions to qualify your participation to participate teleconferencing. What location are you teleconferencing from?
We're at the Portola Hotel and Spa in Monterey, California, in the room Redwood 1.
And Franco, is that the same location?
Yes.
And did you post the agenda at a location where it could be publicly seen at the location from where you're teleconferencing from?
Yes, it's sitting on a chair right outside the door.
Okay. And is the location from where you're teleconferencing from open to the public and ADA accessible?
Yes.
And if a member of the public wishes to be heard at your location, can they be heard by us?
Yes.
And the same answers for you, Trustee Votto?
Yes.
Okay, thank you.
That's great, and there are no other exceptions. To note, we have no other orders of the day, but we do have a need to waive sunshine on item 2G. Do I have a motion to waive
So
sunshine?
moved, Santos.
I got a motion by Santos. I have a second.
Second Gardner.
I have a second by Gardner. All in favor, aye?
Aye.
Aye.
Opposed? Hearing none, that goes. And then closed session. I
Well,
think go
I'm
ahead.
sorry, one thing. So we need to do a roll call vote since two of the participants are participating remotely.
Good point. I should remember that from the pre-COVID days. So let's go ahead. We're going to do for waiving sunshine, item 2G. Franco, how do you vote?
Aye.
And Sunita?
Aye.
Andrew?
Aye.
David?
Aye.
Howard? Oh, Howard's not here. Eshvar?
Aye.
Dick? And Dave Wilson?
Aye.
And this Chair Lanza, I vote aye. Thanks for reminding me. Tech, we'll do that on all the votes. Closed session now?
Chair Lenza, would you like to do orders of the day or go straight
Well, no, we
into-
did. That was
Oh,
them. There
okay.
was only that one thing.
Okay.
Yeah, great. Thanks. we're back. We have nothing to report out of our rather lengthy closed session. Some of it requires signatures. We'll report what happened at our next meeting. Do I have a motion to approve the consent calendar? Motion by Santos. Do I have a second?
Second by Gardner.
I have a motion by Santos, second by Gardner. As Maytak points out, we've got two on the phone, so we'll go around the room. Franco.
Aye.
Sunita.
Aye.
Andrew.
Aye.
David.
Aye.
Eshvar.
Aye.
Dick. Dave.
Aye.
I'm Chair Lands. I vote aye as well. And that brings us to Prabhu. Take it away, Prabhu.
Thank you, Mr. Chairman. We do have somewhat lengthy investment section this morning. We will be discussing 331 performance. Veres has a very important presentation to make, and so on. But before that, I do want to inform the board, we had an opening for an analyst role, and I'm beyond thrilled to announce that our offer was accepted. And this young man, I think, is calling in because he's still at Cal Poly, finishing up his master's. So Harrison Pierce, are you there, Harrison?
Yes, I'm here. Hey, everyone.
Yeah, I think we can see you. So Harrison got an undergrad in economics and finance last year and continued for a year to get a Master of Science in Business Analytics, and grew up in the small town of Sutter, California, which I had to look up in the map, which is outside of Yuba City. And he actually even got a high C on Jay's very tough test for incoming applicants, which I believe is a record. Nobody gets, everyone fails the test. Thankfully, I didn't have to take that. But Harrison will join ORS on June 26th. So welcome, Harrison.
Hi, everyone.
Yeah, welcome. All right. And so with that, I believe Veres goes first. Am I right? Yes.
Oh, Prabhu, did I miss your unaudited numbers?
Oh, yeah. I do have those.
Oh, thank you.
And I have to find it. Actually, they came from Jared or Laura. While I looked that up, so I'm going to sort of introduce the next agenda item. So I believe Eileen's, Mark's here. Hi, Mark.
Hello.
And I believe Eileen's online. Am I right?
She is.
She is.
Yes.
Okay. So we did this very important exercise a few years ago on what our risk tolerance should be for the fund, for the plan, and it was time to revisit that. And so that very important exercise, after a gap of 5 years, was conducted by Veres, and Eileen will share the results. She polled trustees, and they did some other work, and she's going to share those results with you while I'm still struggling to find my performance numbers.
I can give it to you if you like.
Okay, please do. Thank you.
Okay, we estimate fiscal year to date, the pension through, not yesterday, but the day before, was up 5.2%. So that brings the calendar year to date to 4.4. And we estimate that health was up 5.6% for the fiscal year to date. Of that, 4% was this calendar year so far.
And does that beat most of our peers? Because
We don't have the peer numbers yet. They're not updated as
what's
recently.
your sense? Are we still in the
Above median for
because
year to date.
we're still in a crappy economy, which is right.
Yeah, so surprisingly good numbers considering everything that's been happening. But the market's been very resilient. So thanks, Laura. So with that, I will turn this over to Mark and Eileen.
Great. Thanks, Prabhu. So for those of you who don't recognize me, my name is Mark Gazelle, and I work at Veris. I support Eileen and other senior consultants, mostly with quantitative tasks. After putting in a considerable amount of work into the design and execution of this risk tolerance survey, I know that Eileen very much wanted to present the results in person, but it was not to be, so she's asked me to summarize the results for you. However, if the gods of connectivity are kind to us this morning. We have both Eileen and Danny Sullivan on the line to help answer any questions you may have. Also, I know you have a full agenda today, so I'm going to speak quickly, but I'll be sure and pause halfway through and at the end for questions and comments. The last time we did one of these for you was in 2018, and as a rule of thumb, we recommend doing it every 5 years. And why is this? Well, aside from the general benefit of fostering greater understanding between board members, the survey also provides us with support for setting the risk limit established in the investment policy statement. And that limit is currently expressed as a 12% standard deviation of annual total fund return. And roughly speaking, this means that in 2 out of 3 years, the fund's total return should be within 12% of the long-term average expected return. Spoiler alert, we saw, go ahead.
Can you advance the slide, please? Or should I try?
So for those who are following along, we can start on page 2, and this is item 2B in the agenda. So to cut to the chase, we saw nothing in the survey that indicated changing that 12% number or any other aspect of your investment policy, with one notable exception, which I'll come to shortly. And because of this, I won't dwell on the survey process, only noting that the survey was constructed in collaboration with your investment staff and conducted in December with a very good response rate and a decent sample size in the follow-up interviews, which were conducted in January. The complete survey results are presented in the appendix with the questions grouped into 5 major categories, which you see here on page 3. Risk objectives, priorities, appropriate time horizons for both investment plan strategy and implementation, overall investment philosophy, and finally, plan governance. And on page 4, here's what we found. So under objectives, trustees unanimously gave the highest rating to long-term sustainability of the plan. And to that end, trustees indicated willingness to maintain or increase the current risk limit, or risk target rather, in order to meet or exceed the actuarial interest rate as necessary. At the same time, trustees consistently identified return volatility and drawdowns as high concerns. Also, we did not detect a collective appetite for tactical action at the plan level, and instead, the survey indicated that strategic decisions should be evaluated over a fairly long-term horizon. Here's where we may see some need for policy change, with the implication being that asset allocation reviews should occur maybe less frequently than the current annual process. And however, the decisions of staff outside of the investment managers and outside investment managers should be reviewed every 3 to 5 years. In terms of investment philosophy, on page 5, the board as a whole remains confident that alpha can be produced by engaging in active management in inefficient markets, so we have to be smart about that. And that doing so is expected to produce around 30 basis points of additional annual return.
So let me just note that what Mark said is really significant because it's our long-term plan. If it returns alpha roughly 30 basis points, that would take that 6.65 to roughly 7%, which is slightly higher than the median of our plans. And so this is our key strategy, is to have the base portfolio reflect the decreased risk tolerance of San Jose, but have alpha make up a gap so we can hit everybody else. Thanks, Mark.
Thanks, Mr. Chair. In sort of congruence with that, the board is generally comfortable with a complex investment program. And finally, the trustees expressed confidence in staff and comfort with the current governance structure. So this is sort of a 2-part presentation. The remainder of the presentation takes us from the survey results to our recommendation of no change in the current risk limit. It's fairly technical and quantitative. So this is a good place to pause to invite any additional comments or questions regarding our general conclusions or anything noteworthy that you may have noticed among the individual responses, which are presented completely in the appendix to this deck.
So for you, Mark and Jared, so part of the thing 5 years ago was to look at how risk rotates in the macro economy. Are you seeing any? I mean, there is some risk, obviously, from inflation that just popped up. But are you seeing any significant changes in risk over the last 5 years?
It does tend to drift. I mean, these are long-term factor models, so I may have to punt here and see if my risk director is on the line. Danny, do you have any additional insights on that one?
Yeah, I mean, when we looked at this back, it was about 5 years ago. One thing that we did in the development of the risk limit was looked at how a theoretical portfolio had changed through time, going all the way back to the 07, 08 GFC. And what we found was we can build in that buffer such that we don't want to necessarily be making changes in the middle of a drawdown event. So I think that was all built into the way we constructed these risk limits initially.
But I think if I could add, I think the question was kind of what does that risk landscape look like today compared to when we did this 5 years ago? And I think, Mr. Chair, at that time, we were looking at lower levels of volatility compared to today, right? Because what happened is we went into the COVID shock, volatility was elevated and it's remained elevated. And while the COVID or while the pandemic has subsided and the perception of risk associated with that should have subsided, we now have, unfortunately, uncertainty with regards to inflation and rates and potential economic fallout from trying to rein in inflation. So as a result, we are in a heightened volatility environment compared to the last 5 and even 10 years.
Thanks. That was what I was looking for. Thanks, Eileen. Any floors open?
Yeah, so if I could ask a question, page 4, where you say strategic decisions should be evaluated over a fairly long time horizon, agree with that. Now, the second part of it implies asset allocation reviews should be less frequent. Now, trustees did not actually say that. You're just saying it implies, right?
Yes, that is correct.
Okay, I would probably disagree with that, but okay.
Yeah, because, you know, what we found in both the survey responses and the interviews was everyone indicated a desire to sort of put a stake in the ground and kind of stay with that for some period of time and not to be sort of second guessing, if you will. And those are sort of, that's what I'm inferring based on the discussions and the responses. And so as we thought about the results and what the implications are, not related just solely to the risk limits, but more broadly, the strategic decision-making and policies around that strategic decision-making. And so it struck us as incongruent that we undertake a detailed, deep dive asset allocation analysis annually as opposed to 3 to 5 years, which is actually the industry standard in terms of how often your peers. Now, I want to distinguish that from updating your asset allocation policy with current assumptions, because your consultants always update their capital market assumptions annually. So it's important for you to understand how your policy is doing under those revised annual assumptions. But that should be more as a, you know, sort of just revisit, brief review, as opposed to a decision point or a process which involves making a decision.
So is the choice of should correct, Eileen, or should it have been could? Is 1 year worse than 3 to 5 years?
1 year is very frequent compared to how often your peers undertake that exercise, but in particular, based upon the responses related to, and we want to separate strategy from implementation because there was a distinction between the time horizon that the respondents associated with strategic versus implementation. So remember, strategic is owned by the board, and that is reflected in your investment policy as well as in your asset allocation policy as well as in your risk targets. So there was unanimous preference for not revisiting strategic decisions or changing strategic decisions in less than a 5-year horizon, and in some cases more than 10 years. Implementation has to do with, okay, we've set our asset allocation policy. Implementation is actually delegated to staff, right? Because staff then selects the strategies that ultimately are employed to implement or affect the asset allocation policy. And there, the preference that we saw by the committee was, well, we want to kind of look at that more frequently, maybe 3 to 5 years. And that is appropriate, actually. Implementation decisions should be viewed as shorter term relative to that strategic decision, which is should be encompass a longer term period.
Great, thanks. Good answer.
Question here. You know, the whole concept of asset allocation to me is a little gray and fuzzy sometimes. I mean, in the distant past, I always think of asset allocation at a high level as stock bonds. But, you know, when you look at the overall allocation of the plan, it's not so much divided along the stock bond sort of spectrum. It's kind of, you have growth and zero beta, and then within growth, it could be almost a lot of different things. So I'm not sure what the whole definition of, you know, strategic asset allocation means anymore. So I'm just highlighting that that's somewhat gray to me. So in some sense, you could still have asset allocation decision in some sense, depending on how you define it on a more frequent basis. But in another sense, you could say that it's not being changed that much from a, you know, growth asset slash zero beta perspective.
Right.
So that's something that, like I said, it's a little vague.
Right. That's kind of my point, actually, which I think at a very high level, I don't think we should make changes, which is kind of what we did. We reviewed and didn't make any changes. But within those buckets, you know, we may find that emerging markets are less attractive than developed or more attractive, right? And I think we should have the flexibility on an annual basis, at least, to make those changes.
Yeah, no, I agree. I think Eileen's point here, not to detract from the more important discussion around the 12% risk target, is that having observed us go through our SAA process for a couple of years, and the extent to which we do a deep dive into this, and there was some short-termism that creeps into this debate from time to time. I think she's trying to emphasize the point that you're looking at this way too often compared to your peers, and I take that advice, which is good advice. What I would like to do with that takeaway is to bring it to the IC for a more in-depth discussion in August. And we don't necessarily have to change what we do currently, but I would like to, look, we're always trying to improve our governance and to establish ourselves as long-term institutional players. So my goal there is, after having a discussion with the IC, of course it's the IC's decision, but to put some language in the IPS that does not force us to actually revisit SAA on an annual basis and make changes, but to set the tone that SAA is longer term, but we have the flexibility within that longer term framework, as you pointed out, to make changes. And at least for future investment teams and boards, that can be a guiding principle. So,
okay, we can discuss.
Yeah.
If I could just add one, because it does sort of tie into the work that we do in terms of monitoring and reporting on your risk, is asset allocation is a beta allocation decision, right? So whether you've got broad asset classes such as growth, income, and sort of diversified or other, The fact is you've got sub-betas. There's still betas within those broader beta buckets. And it's the betas that typically are not revisited on that frequent of a basis in terms of revising those exposures. Typically, it's more of a 3 to 5 year as opposed to annual, because what we don't want is sort of the tail wagging the dog. We don't want short-term ex ante sort of risk or levels of volatility to drive that strategic decision. So I understand that confusion. I agree as a trustee that probably is confusing, but I think as a trustee, the best way to think about asset allocation is beta allocation, and all those sub-asset classes and main asset classes are betas.
Yeah, no, good point, Eileen. And by the way, I had a conversation with the CIOs of Wyoming and Ohio yesterday, and one of the two systems has an opportunistic bucket, and something that, again, we can talk about at a future IC meeting, where you don't disturb the strategic asset allocation. I've always sort of shied away from tactical, and maybe that opportunistic bucket that the board delegates to the investment team could be a way of, making some of those other decisions without disturbing SAA. So again, things that are worthy of consideration and discussion in future.
Quick question on the relevance of this 30 basis points. Is that just a survey? It's just hard to, is it versus the benchmark, or is it versus 6.625? It's a little confusing what that means.
Yeah, so that's versus the benchmarks. That's the active, the expectation of value added from all of the strategies that are being implemented. So it refers to the expectation of that implementation effort to add 30 basis points, which makes sense because a lot of your public assets are indexed, and you have appropriate benchmarks for your private assets, so you don't have that misfit that a lot of funds have. So I think 30 basis points is certainly a reasonable. So I think there's good alignment of trustee expectations, and probably that reflects a good understanding of how the investment program is constructed.
Okay, thanks.
Excuse me. And that answer is somewhat structured by the survey. If you look in the appendix, I can't really flick to it now, but you'll see we gave you 30 basis point increments, and so most of the answers fell in that category.
Yeah, I mean, given our most of our active strategies are in private markets, for example, or less developed markets from the public side, one would expect a bigger. I don't remember what I answered,
right,
but I would expect a bigger.
So this was I think, as Eileen said, this is at the total plan level. So. Okay, good discussion. If there are no other comments or questions, we're going to turn to our recommendation to keep the 12% risk level. I'm going to skip to page 7. And so these are current risk limits set in the investment policy statement. And you can see halfway down there to the right is that 12% number for total fund absolute volatility. But there are other metrics here that relate directly to the sensitivities expressed in the survey, most notably a 5% probability of falling below a 60% funded ratio. Recall that funded ratio was a primary of concern. So we've got that limit in there. And also a 30% average drawdown for the 3 worst historical scenarios in our risk model. So on page 8, here with Chiron's assistance, we show where you are in relation to those limits. On this page, we take various theoretical levels of drawdown in total fund value over to the left there, and translate those into impact on funded ratio and contributions. And you can see that it would take a 30% drawdown in order to get you down to a 60% funded ratio. So on page 9, we're taking that and looking at the probability of that happening. So if you look at the red line there, 12% risk, and the first column is a 95% value at risk. And what that means is that there is a 5% chance of a 20% drawdown or worse in any given year. CVAR is another measure. It's sort of, if that happens, then what is the average loss? So again, that 95% number is, to put that in layman's terms, that's a 1 in 20 year. And then the 99% number is a 1 in 100 years. So you can kind of see we're getting up close to the 30% if we consider the 1% probability, that's a 27% drawdown. And we are actually kind of bumping over the policy guidelines there for the average of the 3 worst. At 12% risk level, it's a 32% drawdown, and the IPS cites a 30% drawdown. So looking at taking this as a whole is sort of the reason we're not recommending an increase in the 12% risk level. In case you're wondering, very quickly on page 10, what are the 3 worst scenarios? So you look over there to the left, and they are the COVID-19 shock, which produced according to the risk model, would produce a minus 20% return. The 2000 through 2003, it's called here tech crash and recession, but if you recall, it was the dot-com bust followed by the Iraq War, so it was a prolonged bear market. That produced a minus 20, almost 24% drawdown. And then, of course, the global financial crisis in around 2008, which was the sharpest drawdown of the 3.
Hey, let me ask a random question, Prabhu, mostly to you. So we had this weird Vince strategy of let's keep a bunch of money on the sidelines because we have such a long time horizon and invest it as the market falls. Have you ever bothered to apply that algorithm to these historic crashes to see how well we would have done? It'd be interesting to do that. Have you ever done that?
No, I mean, we haven't done that. I mean, it's the issue with that really is one of timing. I think we can demonstrate, we can go back and demonstrate that we would have added a tremendous amount.
Right, I mean, but sometimes it was algorithm, it's down 30%, we do X, it's down 30%, we do Y.
Yeah.
Are we prepared to do that again?
Well, I mean, right now we have a lot less dry powder than we did.
Well, it was building up the dry powder, yeah.
In March of 2020, right?
Are we going to start to do that? Are we going to prime that pump for the next recession?
It's hard. It's a hard question, and it's hard to time this. I've been quite frankly, I mean, in hindsight, in January 2022, we should have lowered our beta, but it's such a difficult call. I regret not doing it now. We could have lowered our beta a little bit. But I think we were also trying to accomplish another goal, and that was, you know, as Veres has pointed out, our risk has been historically very low, right? We have this appetite for 12%, but we were at 9% for the longest time, right? And it came in very handy in March of 2020. The problem is if you, it's very hard to go back to that 9%. And then, you know, and then again and justify taking risk back up again, because I've found just from a behavioral perspective, it's easy to cut risk. It's very hard to put back risk.
Yeah, there's a lot of history.
I think what you're suggesting is we have some kind of more programmatic way of saying, this is a time to build up our liquidity and our cash, you know, and then this is a time to redeploy it. I think it's possible, Drew. We should have done it in Jan 2022.
Yeah, and maybe we just do it on a scale where it's not hundreds of millions, but even tens of millions would have pretty big impact.
Yeah, I mean, it's just the current market environment. We were talking to Laura during the break. Look, we have the war, we have high inflation, we have the Fed's actions, we have debt ceiling, we have Silicon Valley Bank collapse. We have crisis after crisis, and the S&P has been so resilient, right? So how do you time this thing? Right? But look, as I philosophically I agree with that when the market gets very expensive, you cut beta, and you keep some dry powder, and then when you have one of those drawdowns, you know you're going to have those drawdowns again, and then you redeploy it. In fact, last year when we had those discussions at the IC, the S&P was at 3,400, and we said, okay, maybe the drawdown's done. It's too late to do it now. Or maybe if it goes to 3,000, we will actually take some of our dry powder and put it in the market. But it never went back down. So.
Well, that's why it'd be interesting to sort of refine that algorithm and apply it over, really probably only back to 92, 93, the modern era of the new inflation, because the 80s were weird. Okay, good. Good answer. Sorry.
Question, maybe Prabhu or viewers can answer this. The whole risk measure you mentioned of 9%, how's that measured? Can you enlighten me, being the newest member of the board? I'm not familiar with how that's measured.
That's just absolute returns, so standard deviation of the absolute returns.
No, I mean, is it done using a risk model? Are we using the bar risk model on the overall entire portfolio, and that's how we're measuring the current risk of the portfolio?
Yeah, exactly.
Okay,
yeah,
got it. And when we do that, do we like use any exponential weighting of the risk or risk factors, or do we just do a long-term average? Just I know it's a technical question, but being a technical guy, I'm kind of curious.
No, we don't use risk factors, but I let Danny explain how we come up with our. I think it's just a straight standard deviation of our returns, but I let Danny or Mark.
Okay, so actual return calculation.
Yeah,
it's based on the historical numbers.
That's right.
And does that include the privates in there?
It does. Yeah. I mean, you can actually measure your returns.
Okay, so in that sense, since there's stale pricing in privates, there's actually maybe an underestimation of risk?
There could be over periods, and there could also be an overestimation of risk over some periods. So over the long run, you'd have to.
Okay, I just want to get a better understanding.
Yeah.
It's important to note we are employing BAR, and we are loading all of your holdings, and we actually do a fair amount of work, and Danny can describe this in more detail, but capturing, if you will, the risks, specifically the exposures in your private markets portfolios, in order to come up with an ex-ante total portfolio risk expectation. So that 11.2 and even that 9.4 that we referred to on slide 11, those resulted from an ex-ante, not a historical or traditional return volatility risk estimate.
Yeah. So you can look at it ex post, you can look at it ex ante, and there's a distinction between absolute risk and relative risk. So obviously we look at our tracking error too, right? So, and that's an important part of this. And again, once again, it's with private markets, it's very hard to look at any kind of meaningful tracking error. And part of the reason why our tracking error is so low, and you can actually question that, as why is your tracking error so low, is because it's very hard to capture the tracking error on private markets. And since on the public market side, since we index so much of the portfolio, on an overall plan basis, our tracking error tends to be like 1% or lower sometimes. Yeah.
Okay. Yeah. Thank you. I just want to get a better handle and understanding of all the risk number that's out there, because I see that we're trying to get under 10%, 12%, or be around 12%, and then when I see a number like 9.4, whoa, we're really far below. Given the beta exposure we have, that doesn't sound, maybe right. And then I see maybe this expected risk of 11.2, and so what's the difference and what's causing the discrepancy? And I'm just trying to get a better handle on this whole thing, because that leads into me trying to understand the drawdown risk associated with this portfolio and how risky this portfolio is. that's where I'm coming from. Thank you.
Yeah, and our objective has been, for a long time, to take less risk than our peers, partly because of the maturity of our plans and how much our sponsor is affected by drawdowns. So we are very cognizant of that. And when we come up with our numbers, we tend to be either, on par with our peers or lower than our peers. And historically, we've been lower than our peers.
And that was the observation that drove the development of the Alpha program starting in 2014 was if every pension plan should be different, which we believe it is, and if every city plan has inherently more or less risk subject to drawdowns, we are, as you remember from that chart that Bill puts up, we're the riskiest in the state and maybe one of the riskiest in the country because of what Prabhu said, because such a high ratio of retired to active. Therefore, we used to joke before you here, we'll measure it on a curve and measure it absolutely. So on a curve, we should be lower than our peers. And we asked Veris, we'll measure it absolutely. And they came up with this. But it's a pain in the butt to go to conferences and say, oh, we're at 6.675. And they say, everybody says you suck. And we're like, we don't suck. Every plan's different. So really as much for emotional reasons as anything, we came up with this Alpha plan as a way. And so, it's kind of interesting as we talk about it. So the way I think about it, everybody may be different, is that we don't set the discount rate based on risk. We should set the discount rate to match our peers. We should set the core rate, as Veris says, at 12%, 6.675, whatever it is. And then we should try to fill in the gap by aggressively pursuing alpha. And in fact, if you remember when I presented to City Council, I would argue that if we generate more basis points of alpha, we should lower the core return, lower the risk. So we might go back to a lower vol. If he can generate 50 basis points of alpha, then Veris says, look, I think sure your maximum vol is 12. Well, maybe we'll pick 10. Anyway, it's complicated because we really are a unique plan. That's what Bill Hallmark's beaten into us for 10 years.
And if I can just add, not to beat this to death, that's a great point, Drew. But Dave, as you know, active risk, it's better to take active risk than absolute risk because active risk on top of absolute risk adds very little to absolute risk because of the way the math works. So it actually begs for higher tracking error because that does not necessarily, it's not a one-on-one with absolute risk. So you can keep your absolute risk lower and take on higher tracking error and more active management because that's a smarter way for a plan like us.
I agree. Thank you. Sorry for beating this horse down.
If I could answer your question though, to clarify, the 9.4 that you referred to, that's not today. That is what the risk profile of the portfolio was when we initially established the 12% risk limit 5 years ago. The asset allocation was very different then. And then to the point that the chair and Prabhu have made, San Jose had a much lower risk profile relative to its peers. And then that changed, obviously, with the shift to the current asset allocation in 2020. So we're saying today, now under the current, most recently approved asset allocation, that expected risk is now 11.2%, which is very close to that risk limit. So I just wanted to make sure.
Yeah, no, thank you, Eileen. I think I see that now.
Okay.
And I was just kind of pulling a number just because I see so many risk numbers out there. I was just pulling a number just to make a point. Thanks.
Well, it's important to point. I mean, that is the whole point. Is our risk is unusual, so therefore, we had a guy named Darren, and at the offsite where Veris did this, he kicked off. We went around the room saying, "What do you think?" And I can remember his exact words. He said, "This is an important meeting." Quote: "We don't have a culture of risk. We do now, and you're part of that. So dig."
I had one mechanical follow-up and one sort of more conceptual one. I remember when we did the SAA discussion, Makita had adjusted up the wall on the private markets Does Veris do that to address what David was talking about for these risk numbers?
So again, our risk is holdings based. So, and we try to, and I guess I look to Danny maybe to specifically describe what we do in the private markets, but we do try to align the risk models given the risk exposures that are observed in your portfolio. So not just a generic assumption related to risk for private equity, but really more honed. It's not perfect, not as robust as your public markets risk forecasts. But Danny, I don't know if you have anything to add to maybe provide further understanding of how we're modeling the private markets.
Yeah, so we leverage, within BARA, we leverage their private equity model when we're looking at the private equity assets within the portfolio. And that actually de-smooths the returns within private equity to try to get at the true volatility of those assets because, they're appraisal based, right? So if we use the actual quarterly returns, then the discussion has already been had in this meeting. It basically underestimates the risk in those portfolios. So the model that we use within BARA tries to capture the true volatility by de-smoothing those.
Okay.
Does your VAR and CVAR analysis do that too?
So that's those assets are part of that calculation too. Yep.
Thank you.
So the vol numbers that Veris uses could be different from the vol numbers that we use for SAA, for Makita?
No, in your SAA, we provide the vol numbers so that they're consistent.
Yeah,
Okay.
we get two sets of numbers, one from Makita and then one from Veris. So Makita will run its own analysis, but because the board uses the 12% risk limit that came from the Veris analysis, the numbers that are shown to you in the board package for SAA analysis comes from Veris.
Okay. We can take this offline, but I think Danny's answer about not smoothing, is different from what I remember hearing what Laura's talking about private markets. But again, this is too technical for a board discussion. Let me ask my second question. It's probably more the discussion today. Would increasing, we seem to be in the middle of the road in terms of conservative, aggressive, if I look at page 9. Would increasing the risk tolerance, risk limit to 13% give you more comfort to make tactical allocations within the portfolio, Prabhu?
Not really. I think what would give me more comfort with tactical allocation is if we have an opportunistic bucket. I don't think the risk limit is what's preventing me, because I know that if I want to take more risk, I can come to the board and say, you guys decided 12, can you please raise it to 13? Because there's opportunity there, right? It's the board mandated.
It's a once in 5-year exercise, or do we do this annually?
No, this is a long-term exercise, but I think that doesn't prevent me from requesting the board, like next year, for instance, if there's a deep drawdown and we really want to take on more risk, I don't think this prevents me from coming to the board and saying, we actually want to increase our growth assets. So I feel comfortable approaching the board on that.
Okay, that's fair. But I guess the follow-up to that is, given our funded status, I understand there's also the maturity of the plan. And I also understand that we are an outlier versus the peers. But let's sort of keep all that aside. Should we be taking more risk to bridge that gap? Should we allow more in the plan to go to 13%, for example?
Yeah, I'm not sure that decision is independent of the impact on our sponsor to some extent. If you were to tell me that there were no considerations and we're not worried about drawdowns and the impact it will have on our sponsor, the answer is yes.
Okay, that's fair. We have a pretty strong sponsor. Right? I don't know what the rating of San Jose is. I should know.
The rating of San Jose is very, very strong from the credit standpoint. But so let me just add, because we keep referring to we are different than our peers, and that part of the equation, I think, as Prabhu suggested, cannot be taken outside of the equation to answer that question, because when Chiron comes before you, the reason we are very different is because we are very mature, our membership. So our ratio of actual active members versus those that are already receiving a benefit or defer is much higher than our peers. What that means is that investment gain and losses have a much higher impact in the plan than our peers.
Got it.
And when that happens, then that's really what drove this board to start a lower risk framework and approach, because they figure, hey, when things go sour, it's going to be impacting us and the plan sponsor a lot more than it impacts other
That's fair.
peers across the state. So
That's fair. You're right. We can't look at it
Let me-
outside of maturity.
Yeah, let me
That's fair.
just add this before Harvey gets upset. We are fiduciaries to our beneficiaries, not to our sponsor. And every decision we make is for our beneficiaries. And so if I feel like that there's opportunity in the market that will enhance our returns and favor our beneficiaries, I will come to the board and ask for greater risk.
It's good that you're balancing risk and expected return. Thank you.
So I was the one that led the effort on grading on a curve, and Vince led the effort grading absolute. Vince was chairman and drove the meeting where Veris presented this 5 years ago. So let me tell you what the rationale for grading on a curve is. So there was a New York Times reporter who published a book a few years ago, The Wisdom of Crowds. And so it can be shown that a sufficiently large number of educated people are very smart, right? None of us is as smart as all of us, as one of the management consultants said. So what we did was look at the median return of our peers and then look at how much any given drawdown would hurt them at that median discount rate. Then we computed an asset allocation to match that discount rate. And then we said, well, if we wanted to feel the same level of pain as our peers, how much less risk would we have to take, because we inherently are more prone, we feel the pain greater. And that number ended up being somewhere between 25 and 50 basis points, which led us to go to 6.675 if the median was 7. It's interesting, Bill Hallmark sent an email to me 2 months ago. The median's now about 6.9. So it is possible there's a feedback loop there, because once we went down before anybody else did, people started following us down. Well, did they just follow down, or did they follow us? I mean, who knows? Probably everybody was going down. Everybody realized this. So on a curve at 25 to 50 basis points below our peers, pain gets normalized. Of course, then you asked the right question, were you here at that first meeting with Mayor Liccardo when he said, well, I know you have a lower discount rate, but we have a really strong city? Man, good point, Sam. Right, so there's no right answer, but it does seem like we should take a little less risk than our peers. And the question to Veris, and then to me with grading and curve, is what the heck does that mean, and can you quantify it, which is why we're here.
Got it. Thanks for entertaining the question. Appreciate it.
So thanks, everyone. It's an important discussion, and I think we've had a good one today. Unfortunately, I've just lost my battery, so I think Eileen's going to finish up on page 12 she's already sharing the screen. So in general, our conclusions are that you're still aligned on your definition of key risks and prioritization of those risks. Funded status, volatility, and drawdown risk remain key board concerns, and we think that's right thinking. There appear to be a shared vision of how to invest the assets, strategic versus tactical planning, staying well diversified, and utilizing private markets. Then the issue we're kind of leaving hanging is whether the board should revisit the language regarding the frequency of SAA reviews. So thank you for your time.
Well, as we said to Veris 5 years ago, this is just top-notch work. Is anybody else doing this at this level? Do you know?
A couple of state level plans, but certainly no municipal that I can think of.
We're very special, aren't we, Eileen?
Yeah, all in a good way.
Any more questions? If not, Prabhu, back to you.
All right, thank you, Mr. Chairman. I'm assuming there's no action required since the risk tolerance level is unchanged. Yeah, okay. With that, I believe we will now go to discussion of our performance, and I am going to invite, I think it's Paul Dackett instead of Casey Boyer this time from Neuberger Berman. Paul, it's all yours.
Hello, and thanks for your time today. I'll try to be relatively quick. As Prabhu said, this is Paul Daggett. I'm a managing director with Neuberger. I've been with Neuberger for 19 years now. I've worked on the City of San Jose mandate since it began in June of 2017. Let me just quickly share my screen. So
yeah, we've got it. We can see it.
Oh, perfect. So in the fourth quarter of the year, this looks at the summary in the usual format. The fourth quarter was relatively quiet, both in terms of private equity markets and activity, but also in terms of valuation movements. And so really just to talk about the progression of your private equity portfolio. On the left, of course, is your legacy portfolio. In the middle is the Neuberger mandate since 2017, and on the right is the combination. First of all, in terms of activity, we made 2 primary fund commitments, 1 secondary, and 2 new co-investments in the fourth quarter of last year. So some activity in that regards, and committed a total of just under $47 million in those transactions. The amount of contributed capital towards the bottom of the page, 205 million, that increased by about 11 million during the quarter. So as I mentioned, it was relatively quiet, and distributions were even quieter, essentially unchanged during the quarter. And then in terms of valuations, again, I mentioned that Q4 in private equity in general, and more specifically in your portfolio, there wasn't a large valuation change. So the legacy almost exactly the same at 1.6 times and 9.8% IRR. The Neuberger program at a 1.8 times net multiple and just under a 25% IRR, also essentially unchanged. So obviously the combined funds were the same. So as I mentioned, really just a relatively quiet quarter for the portfolio after, of course, what was a year where valuations did move around a little bit, but ultimately underlying performance of the portfolio in terms of the Neuberger portfolio was good. I'll just move forward to a bit more detail on returns. So this slide has at the top a breakdown of returns in the program gross, so that is pre NB fee and carry, but including fee and carry of any underlying funds. And at the top line, primaries, which is just over 70% of the portfolio, continues to have good returns. Secondaries and co-investments really doing their job as well. Secondaries are 4% of the portfolio, co-investments 26%. But you can see the IRR is very strong, as you would hope, but also in particular, the DPI, the amount of capital distributed back from these investments is also higher than in primaries, which is the job of these types of investments.
I'm a VC, are those TVPI numbers typical to you, or are we beating the TVPI numbers?
these TVPI numbers are on a gross level, but after fund returns. Was the question how they're different to the overall mandate?
No, I'm saying I know what TVPIs are for just the VC seed stage sector. Are these TVPIs typical or better than average in your history as you look across many different instances and many different types of private equity?
Yeah, it's a difficult question to answer because obviously vintages are different and every portfolio is different. But I would say, broadly speaking, yes, for a program of this profile and age. And in a way, a better way to look at this, of course, is the program as a whole, which is the next section down, where you can see the net IRR and multiple for the program over time. And obviously the vintage is 2017, but we've invested every year since 2017, including last year. But those are the net return multiples, and these show the benchmarks from Burgess and where this mandate currently benchmarks. So, and again, this is quite similar to the last quarter. And I would say, for this mix of primaries, co-investment, secondaries, for the vintage profile, these are, I think typical is a reasonable word to use. But, obviously there will be differences in different programs.
Great, that answers my question. Thanks.
And obviously, we would, particularly the primaries, we would expect those to continue to develop over time. And obviously, the goal is not a multiple of 1.5 times, and the 23% IRR I think is good. But we would hope that multiple will continue to increase. And of course, secondaries and co-investments, part of the job is to help with that J curve mitigation, and that is what they have done to date. So I think with that summary, trying to keep it fairly brief, I'm happy to take any other questions that anybody has.
So one question, maybe it's for Dinesh, but so we don't actually see the performance for the quarter, but if I look at the Makita report and look at private equity for the quarter, it's a minus 6.8, I think. Would that actually tie into the Neuberger performance for the quarter? Is that?
No, because there's a lag, especially for the year-end numbers. Year-end numbers are audited, so they won't correlate since there's a 45 to 60-day lag. And for the year-end results, which is the Q4 report for Neuberger, that actually wasn't available until much later, so April. So it won't be included in the Makita report that we'll see later today.
So this is Q4 of last year, 2022.
For the actual fund returns, however, for the Makita report, those are based on the custodian calculated returns. So the custodian, in the middle of April, they'll cut off their calculation of collection of statements. Yeah. So that wasn't included.
But the Makita report is for Q1 of 2023.
Q1, but the Q4 performance for the Neuberger Fund of One was not available by that time. So that was not captured here. We'll see it in the Q2 Makita report.
Oh, okay.
I can tell you just in terms of the multiple we reported at Q3, it was 1.76 times net for the program versus the 1.77 time you see here. So the valuation change was fairly small from Q3 to Q4. Obviously, that will factor in new capital going in as well as any valuation change in the existing portfolio at that time.
Okay, thank you.
Question. Paul, made this more directed to you. What's your expectation going forward for 2023 as relates to the value here at TVPI? Just because you hear so much about private market valuation resetting, and I've certainly seen some of that, resetting going down actually. So expectationally, what do you think?
Yeah, I think. And I presume the question pertains to the existing portfolio as opposed to new transactions in the marketplace.
Yeah, existing.
Yeah, I mean, I think with existing, then the valuation methodology is likely to continue. So, and that includes public markets as one input, typically in a buyout valuation, along with sometimes DCF, and of course comparable transactions in private markets. But I think that methodology will continue throughout the year. And so I wouldn't expect any change there. So really the two variables are, what do the public markets do? That is one factor. And secondly, of course, the performance of the companies in the portfolio. And again, it's a pretty significant portfolio at this point in time. So I'm generalizing, but I think portfolio performance at the underlying company level held up quite well during 2022. And if that continues in 23, I would expect, putting all those things together, valuations to be relatively stable. There's not a sort of a catalyst for, I hope there's not a catalyst for a downward movement. And equally, I think that's probably true on the upward side. So I would expect, within a single digit bound, valuations to be relatively stable this year.
Thank you.
Question on page 11, probably for Dinesh. Seems to be a venture capital growth equity exposure within this, for about 36 million commitment. Is that separate from our VC allocation? And
So when this program was originally established with Neuberger Berman, there was no separate venture capital allocation. So we were making both buyout and venture allocations within this program. But once we created a dedicated venture capital asset allocation target, then that was separated out, and we stopped making investments through here that were venture.
so so Neuberger under the mandate now no longer makes VC commitments. Is that
Correct.
right? Okay. And when we report, I mean, I guess it's not a material number, but 37 million is left under this program.
Correct, yeah. So there is a legacy that's 9 or 10% of the overall program that is venture/growth. So there is a possibility to still make growth equity investments that are in between that line between buyout and growth. But going forward, there will be no more venture investments, and those venture investments we continue to monitor with Neuberger.
And then one other question, if you look back at page 2, we had 44 million in distributions and 40 million commitment remaining. So is the 44 million within the reinvestment period, or is there $84 million of dry powder or $40 million of dry powder?
So the way to look at this is that the commitment remaining is commitments that we've made based on our pacing plan that have not been committed to underlying investments yet. So that's where we work together with Neuberger Berman to find primary funds, co-investments, secondaries to invest throughout the year. So that's that 40 million. The 44 million of distributions that have been distributed back to us are just capital that has been returned from investments that have been realized. So those are different numbers. And I think what you're getting at is the uncalled dry powder, which...
No, I was wondering if the distributions were still available for reinvestment, or it's out of the reinvestment period.
In some cases, through primary funds, they are available for recall. For our particular distributions, the most of them have actually come from co-investments, so those are not subject to recall.
Okay. And because, to David's point, it seems like, there's always a lag between the valuations, and private markets might give you that sort of boost, I guess. So, but, yeah, thanks.
Just one more question. There are two, I think both are co-investments with substantial decline in value, just bad marks, or?
And the two you're referring to...
Page 10.
Page 10, yeah, sorry. So I think the co-investments include public positions where there has been an IPO after we made the investment. And I think that could be the cause of those, that they're public investments throughout the year. Let me just...
Any more questions? Over to you, Prabhu.
All right, thank you, Mr. Chairman. And with that, I'm going to turn this over to Laura.
And one quick note before Laura begins, I wanted to share an update on the private markets report that is worth noting, since it's usually buried in the footnotes. So as you know, we show peer benchmarking to compare our returns versus peer universe of similar strategies that began investing in the same vintage year. Historically, we used a provider called Cambridge, but last year Cambridge began increasing their prices, restricting usage so that our consultants could no longer use them in public reports for us. So Neuberger and Makita both switched to different providers. Neuberger switched to a group called Burgess. Makita has been reporting based on a group called Preqin. And internally in our team, we've been looking at the universe of different providers. We recently contracted with a group called Burgess, which is what Neuberger was using. And this is the first report that actually shows Burgess data. We found that Burgess had a really large universe of over $10 trillion of private assets that they capture within their universe, better data quality, and also some interesting functionality for us to drill into the underlying data. So throughout this report, you'll see Burgess data, and also want to thank Makita's performance and reporting team for being able to integrate it so quickly. Thank you.
Good morning. I suppose it's still morning. It's nice to see the sun in San Jose since we've had Meg Ray and clouds in San Diego for about a month now. We have 3 reports for you today, the public version of the private markets report, the pension fund total fund report, and the healthcare trust as well. So if we take a look at the slide on the screen here, let me see if I can make it larger. So you can see the total account, each private markets asset class on page 1 of 53. You can see that on the far right, if we take a look at the internal rate of return of each private markets program and compare it to a public markets equivalent, so if you had put the same amount of money called by the private markets program into the relevant public market index, so a high yield index for private debt, a real estate index for real estate, et cetera, you can see that your program IRRs are outperforming the public market equivalent in every case. And the total private markets program has an internal rate of return of 10.2 as of the end of December.
Is that alpha?
That's alpha if you had put the same amount of money into and out of.
Right. Yeah. Oh, right. Because,
so the individual partnerships are calling and distributing capital on their own, so that accounts for that.
It's not quite, but it's kind of.
Mm-hmm. And then we get into the individual programs. So starting with private debt, you can see on page 2 of 53, the IRR of 6.4%. The target for private debt is 4%, and the current allocation is quite close to that as of the end of December at 4.4. There were no new investments in this program during the quarter that we're looking at. And if we look at individual funds in the program, you can see especially those that were committed and have vintages since 2017 are, with one exception, all significantly outperforming their peer IRRs. And as Dinesh mentioned, these peer IRRs are now from Burgess, which is a group that Makita has a lot of respect for as a peer provider. Eagle Point Income is the only one that falls below that. They had a number of fixed rate investments that didn't adjust for inflation, which is one of the reasons for that lower IRR. Moving along to the real assets program, starting on page 8 of 53, you can see that this is a less mature program than private debt. It currently has an allocation of 2.2% of the overall plan relative to a 4% target. So the team and Makita are continuing to look at new opportunities. There was one new fund, one new commitment during this quarter that we're looking at, HIG Infrastructure Partners, with a commitment of $19 million. And you can see the individual performance of the funds on page 11. And as you can see, you have some strong returns, in particular, Kimmeridge Energy with an IRR of 40.9% relative to 16.6% for its peer IRR. Taking a look at the real estate program, you can see that it is also quite close to its target, a mature program at 4.5% of the total plan relative to a 4% policy target. There was one new investment in DRA Fund 11 of $27 million. And when we take a look at individual returns historically for funds, you can see why your staff and Makita wanted to continue to commit to DRA and re-up given past returns there. And you can see some strong IRRs relative to peers in the real estate program as well. The last one that I'll take a look at from a program level is venture capital. So this is also a quite new program, as you all know. Less than 1% of the total plan as of the end of December relative to a 4% policy target. There were no new commitments during the quarter that we're evaluating. And you can see the individual fund commitments, most of which don't have meaningful returns yet, given their vintage years, on page 22. So I'm happy to answer any questions on this public version of the private markets performance.
Floor is open. Keep going, Laura.
Okay, great. So I will move to the next item. All right. Here we have the total fund quarterly review for the pension plan as of the end of March. Just to lay the groundwork in terms of market performance through the end of March, you can see here on page 5, 2022 returns for major indexes on the left. It was a challenging year, as you all know, with negative double-digit returns for both bonds and equities. The only positive major asset class being the Bloomberg Commodity Index. And then we really saw that reverse in the fourth calendar quarter of 2022. And you can see year-to-date 2023 on the right. You can see the Bloomberg Commodity Index was then the worst performing asset class. So a very different market environment, which I think indicates to me how difficult it is to make tactical decisions given the stark contrast here. If you take a look, non-US developed equities were the strongest asset class year to date. And if I take a look at index returns that are not on this page but are more recent, so the quarter through the end of May, so the first 2 months of the second calendar quarter of 2023, we saw pretty flat returns for a diversified portfolio of 60% equity and 40% bonds, which a lot of folks use as sort of a proxy for the market as a whole. We saw the S&P 500 up 2% in the first couple months of this calendar quarter, while emerging markets were negative. Bloomberg Commodity Index continued to be more negative for the past couple of months, down another 6.4%, while the bond market as a whole was just slightly negative. So it's interesting to me that we had, year to date through the end of March in this chart that you see where we had a global, or regional banking crisis and some other market factors that were quite negative, and you see very strong returns. And now we're seeing, flat, slightly negative returns in what has been perhaps a more docile market, although we did have the debt ceiling weighing on markets. Getting into individual plan asset allocation and performance, I'll skip to the watch list. As you know, in your investment policy statement, we put managers that have a lagging return relative to the benchmark for the 3 or 5 year period on a watch list. The good news is that your 2 managers on that watch list that are lagging for the 3 year period both have top quartile returns since you hired them. So that is likely to be a shorter term situation.
You think that's just due to sector rotation?
And market environment, I think, there's idiosyncratic factors with these managers and their portfolios, and, can't guarantee that things turn around, but our research indicates that, most strong managers do have 3 year periods of outperformance interspersed with their stronger returns. We can take a look at the total plan value as of the end of March. The numbers here, you can look at growth at 3.2 billion, low beta at 723 million, and other at 636 million, and allocations quite close to policy targets. Getting into performance on the next page here, you can see quite strong returns relative to generally all benchmarks. Please ignore the alternative investable benchmark. We were messing around in our system with some benchmark calculations, and obviously that's an incorrect benchmark since nobody's going to beat a 53% return for a 1 year period. We'll be sending a new version of this for posting over to your staff, but during one of the rounds of edits that we do on this report every quarter with your staff, that snuck in there somehow. So if you take a look at all of the benchmarks that should be there, the policy benchmark, the investable benchmark, the low-cost passive portfolio, and just a diversified portfolio of 60% global equities and 40% global bonds, you see really strong returns for your plan. The quarter to date up a positive 3.8% for that first calendar quarter of the year. The 1 year period, while it was down negative 3%, we did just look at those market returns, which were much more significantly negative. If you look at the peer relative returns, the plan is above median for the quarter, and in the top quartile for the 1-year period, also at or above median for the 3 and 5 years. We have a lot of individual performance data in here, which I'm going to allow you to peruse at your leisure. And I'll take a look at overall plan statistics to a greater degree on page 58. So looking at the total fund for the trailing 1-year period, again, you see on the left that the return ranks above median. You see in the second box here that the standard deviation ranks below median, and that results in risk-adjusted returns in the third and fourth column here that are top quartile. And we've seen that trend persist for some time now in your plan. We have more slides here. We have more peer relative information as well, and then a variety of other major benchmark returns and statistics in the rest of the presentation. But with that, I will take any questions that anyone might have on the pension plan performance.
Good, floor is open.
Question on the watch list managers. So when you talk about the 3 and 5 year performance, is that how long we have been with them, or is it just their own performance?
That was you have been with both of those managers for more than that period of time. So everything is for your plan independently. So that was something that was added through a city audit request a few years ago, that they wanted the reporting to have a watch list included. You know, as you know, your staff and Makita and other consultants are watching all of your managers on a continual basis. But I think one of the city audit recommendations was that you include in the report that if a manager had underperformed for 3 or 5 years, and call that out.
Yeah, so I mean, that's fine, but it's good information, I guess. I'd like to know whether why we want to continue with them or not.
Sure. I'll highlight one of them, Artisan Global Opportunities here. So you can see the 3-year return at 11.9 fell below the MSCI ACWI Growth Index at 14.7. So that's why that manager is on the watch list. If we look on the far right, you see the since inception return, which is well above both the peer median and above the benchmark here as well, and in the 15th percentile. If you also look at quarter to date returns, while below the benchmark, are significantly ahead of global equity on a peer relative basis. So this is a manager that you all have been invested in since 2013. So for a 10-year period, that has done well over that long market cycle. The Artisan managers were reduced in asset size recently, mainly because even though these are 2 separate investment teams, there was a bit of concentration there, with 4.7% of the portfolio in global opportunities and 6.2% in global value. And we like to keep an eye, along with your staff, on how large each individual manager position gets.
Question related to that just came to my head. Are they running a portfolio that's consistent with their strategy of targeting growth? Meaning, you looked at their portfolio, they have tilts toward growth factors?
Yes, they do. So the 2 Artisan portfolios, one is tilted towards value and one towards growth, and we do monitor them regularly for signs of style drift.
Thank you.
At what point do we review an allocation to Artisan or somebody else if they're underperforming?
Well, I mean, we're constantly looking at these managers, right? And we're always talking to them. Artisan is a long-standing relationship. And Christina, you probably get on quarterly calls with them. I happen to know their CEO, so I also talk to them. And I also talk to their portfolio manager. And so it's a continuous evaluation of their process, of their style, and whether we have conviction or not. I'm generally less concerned about underperforming managers than I am about turnover of portfolio managers and other, firm level, changes that could impact portfolio performance. So what I'm really looking for is high conviction and sticking to their style, and whether that style fits in with our overall portfolio.
Question. Do you have a report that shows kind of an attribution as to what's contributing to the outperformance of our fund versus, like, I don't know, the benchmark or the peer, so that we know that when we're outperforming, it's due to the allocation to X? Do we have something like that?
Yes, and I neglected to focus on it during the
Sorry.
presentation. I apologize. So we do have some attribution analysis for different time periods. You can see on 53 of 77 here, the 1 year. So we see the green bars are the selection effect and the blue bars are the allocation effect. Having any allocation to cash over the last year was a positive, given negative returns in the market environment. But if we look at the total fund on the top there, we really see a pretty equal or significant contribution from both allocation and selection to the outperformance relative to the policy benchmark.
Thank you.
So, Prabhu, why is the overlay so negative?
I can't see the report, sorry.
My assumption is because it wasn't in cash. So during 2022, if most of the time, if we leave excess cash in cash, it's a drag on the portfolio during up markets. But in 2022, it would have been positively more in cash and less in an overlay.
But what was the overall market down? The overall market wasn't down 33%, was it?
It was not, no.
No, don't worry about it, Laura. It's just, I'm just curious.
Yeah.
Don't worry about it.
Jay, do you want to add anything?
Yeah, right. Right, so we sort of saying overlay is just a very noisy bucket of worms. Yeah, it's a Stanford thing.
Actually, it seems like a big portion of the outperformance came from cash. How much cash did we have?
So you had some frictional cash. So if we look at the actual asset allocation, there wasn't a big allocation to cash. You can see that it was actually a negative current balance because of the overlay. But whenever you switch managers and hold some cash for some time, that represents, a cash return. You do have the immunized cash flows, which are a significant portion of the plan, almost 13%. So that's a big holding in cash equivalent short-term bond type assets.
So that's counted as cash?
Not on the attribution, no. That's
Not
counted as a separate category.
Okay.
Yeah.
It's hard for me to
attribution seems like it should be
negative cash and we're outperforming. Okay.
One of the reasons I don't highlight the attribution is it seems like it should be very highly scientific, but there's a lot of noise in that analysis.
And a bucket of worms. Don't forget the worms.
Yes.
Any more questions? You're still on, right? You've got healthcare
I've got
to do?
healthcare.
Excellent. We love you, Laura.
All right. So on the healthcare portfolio, you can see the total current balance of $285 million and current allocations quite close to their policies. As you know, there's no private equity or private markets in this portfolio. The closest we come is core real estate. You can see the total quarter return at 3.8% for the first quarter of 2023, bringing the fiscal year to date to 5.4%, and then the 1 year to negative 4.3%. So a slightly more negative 1 year return relative to pension, given that you don't have those diversifying asset classes on the illiquid side. But that 1 year was quite close to median, and you see the fiscal year was close to the top quartile. In terms of individual asset allocations, we see, mainly index funds in your portfolio, and so you see returns quite close to the individual indexes and also a low tracking error. You can see some of the individual stats and also a top decile Sharpe ratio or risk-adjusted return in that third box there for the 1 year period. So a healthcare trust holding up well, like your pension.
Any questions for Laura? Glad we could bring you a little sunshine.
Thank
You always
you.
bring us a little every time you're in
oh,
person.
thank
Ha ha ha. Right. So.
Thank you, Chairman.
All right, thank
Anything
you.
to go back to, Peru.
Thank you, Drew. Normally, the investment section is not this long, my apologies, but we have one last item. Over to Ron.
Hi. In your packet, you have a memo from me regarding the subscriptions that need funds added to. These are the 7 vendors that provide data services to the investment program. We are requesting to add funds for 1 year to continue services, and the cost of the subscription is split 50-50 between the federated and the police and fire plans.
And these are the total numbers, right?
This is, yeah, so the...
we pay half of these?
Yeah, so the column, actually, on my memo
Oh, I
on
see
the right...
it's on there. Yeah,
yeah, on the right column shows the P&F portion.
Yeah, insert mouth to foot, foot to mouth. There we go. Prabhu, anything? Anything here stick out?
No, I mean, these are all very important data sources that we use. So.
Any questions? I'll entertain a motion to approve this.
So moved.
I got a motion by Santos. Do I have a second?
Second.
I have a second by Kwan. Let's see, we got to go round robin again. Let's see, here we go. Vado.
Aye.
Sunita.
Aye.
Andrew.
Aye.
David.
Aye.
Eshvar.
Aye.
Dick.
Yes.
Dave.
Aye.
I'm Chair Lanza, but aye. That's unanimous. Thanks. That's it, right, Prabhu?
Yes, we're done.
We,
Thank you.
We have an empty old business section. On to new business. Over to you, Roberto.
Thank you, Mr. Chair. So I have a short oral update for you this morning. I do want to, I'm sure you have noticed that in the administrative staff, we have some new faces. And so I wanted to welcome to the staff Edith Aldama, which I just met this morning. Welcome, Edith. And also Cheryl Alero, who is also there with us. She's been here before, but she's now a member of the staff on a permanent basis. So congratulations and welcome to both. These are the 2 new staff specialists that were hired through the personnel process that we initiated a few months back. And one of them will be in charge of the Police and Fire Board meetings, the other one federated, and they both will be reporting to Michelle San Miguel, which, as you know, is an acting executive assistant. And although you cannot tell right now, she's so excited to be working with me directly these days. I also wanted to let you know that as we do every summer, we have our office picnic planned for not this Friday, but next Friday, June 9th. It will be held outdoors at the Kelly Park. It will be in the afternoon, so I think at this point, Barbara, if I'm not mistaken, we are considering having, as we've done in the past, close the office for the afternoon?
That's correct.
Thank you. And I wanted to let you know also in the summer that the office will be closed on Monday, June 19th, in observance of Juneteenth Day, and also, as you know, probably Monday, July 4th, in observance of Independence Day. That concludes my update, Mr. Chair, but I'm happy to address any questions.
Any questions for Roberto? If not, over to you, Pam.
Thank you. Really interesting presentation today. A lot of complicated terminology that I'm trying to get my hands around, but it's helpful, very useful for me. Just briefly, we're in budget season right now, and we will be adopting a budget June 20th, which has impact on all of the services that we offer in the city, the priority being public safety, making sure that we have a robust public safety, all aspects of public safety, be it police, fire, and street improvements to make our streets safe. You may have seen our Vision Zero new marketing campaign to encourage people to slow down, called Slow Down San Jose. We have real impactful billboards with a picture of a bicycle helmet upside down and a little shoe in the middle of a crosswalk. So That is visual to encourage you to please slow down, not just when you're driving in the city of San Jose, but when you're driving everywhere, because we lost 65 lives to pedestrian fatalities last year, and we don't want to break that record. We want to decrease the amount of people that we lose on our streets. So please drive safely. The other focus on the budget is homelessness and affordable housing. On June 6th, next Tuesday's council meeting will be approving 2 emergency interim housing facilities. One will be in my district on near Valley Water property, thanks to the cooperation from them. Actually, not near, on Valley Water property. And the other, not sure where it will be, but a proposal is in District 4, so North San Jose, but it could be in South San Jose too. No, I don't know about that one yet. That's the priority, and of course, getting the budget is really critical because that enables us to move forward in with our services that we offer. No, since we're in budget season, that is the main focus. And if you have any questions about that, I'm happy to answer it.
Any questions for our friend Councilwoman Foley? Going once. Thanks, Pam.
Thanks.
Over to you, Roberto.
Yeah, thank you, Mr. Chair. And actually, I'm going to turn this over to our Deputy Director, Barbara Heyman. Barbara?
Hi, yes, good morning. Barbara Heyman, Deputy Director. This memo is requesting approval to negotiate and execute a 4th amendment to the agreement with Marty Boyer of Communications Advantage to extend the term of the agreement through to June 30th, 2024. No additional budget is being requested at this time. Ms. Boyer primarily works with ORS with our newsletter and our social media posts. And per board policy, the CEO is authorized to enter into a contract up to $50,000 in value over the term of the contract. Any contract above this requires board approval, and board approval is also required for any contract that would result in a cumulative contract value with a single vendor of over $50,000 over 2 consecutive years, which is the case for this agreement. So staff are requesting approval to negotiate this 4th amendment to extend the term.
Any questions? When did we first engage them? It's been quite a while, hasn't it?
I believe it was, well, this is the 4th year, because this is the 4th, yeah.
Good, great. Any questions? Entertain a motion to approve. Got a motion by Santos. Do I have a second?
Second, Gardner.
I got a second by Gardner, and we will do it again. How do you vote, Franco?
Aye.
Sunita?
Aye.
Andrew?
Aye.
David?
Aye.
Eshvar?
Aye.
Dick? Dave? Dave?
Aye.
I'm Chair Lanz. I vote aye. That's unanimous. I guess you have, is that you, Eshvar? You've got, that's JPC, right?
Yeah.
So over to you, Eshvar.
Yeah, okay. Thank you, Drew. So last meeting, we went over the salary discussion and the adjustments that we made. The second part of, looking at incentive compensation was incentive compensation. And I think this was, I would say, more challenging in the sense that we don't have as many reference points, if you will, right? And before I start, let me first of all thank a couple of people. First of all, Drew, who kind of initiated all of this. And I think this discussion started last year when Elaine of the Federated was the chair, and Elaine and Drew were kind of running this. Yeah. And then Elaine left, and I took over. I was, I guess, a substitute chair as a vice chair, and then I took over as a chair. And I think we had a lot of things to look at and reaching consensus and all of that. So it was I would say somewhat of a tough assignment. Second, I'd like to thank Andrew. And Andrew, I would say, is like the Christian McCaffrey. I mean, he does a little bit of everything, right? Very good at a lot of different things. The football player. So he the salary survey which he discussed, he was helped me a lot in terms of the incentive compensation. And so thank you to Drew and Andrew and Harvey. Harvey was useful in kind of connecting us with Orange County, which actually has a program. And actually, he brought 2 of the trustees to present before the JPC. So that was great. And I think one of the attachments here, which is the considerations for incentive comp, the kind of things that we looked at, was also something which Harvey drew up. And Makita helped us with various calculations in terms of trying to see if we did have this incentive compensation historically based on some of the metrics we were looking at, which had not resolved as yet, kind of what they would look at. So thank you to a lot of people, who've done a lot of work on this. So like I said, there's only 2 plans in California which actually have this, and potentially, which is San Bernardino and Orange County, and so we use them as a reference. San Francisco supposedly has a plan, but we're not sure what the details are. So there's less data in terms of what we have. But the thinking here, like I said, when Drew kind of talked about this was, how do we incentivize to keep our staff and make sure that kind of the change in performance where we have, we think we have good performance, right? That's maintained. So that was kind of the thinking. And it's an incentive comp where, if the performance is not there, the pay is not there, right? So the salary is there, and this is on top of that. So those are the kind of thinkings. Now, one of the attachments and considerations, the JPC went through a lot of with all of these, but we're only at kind of step 3. So 1, 2, and 3, that's what's been approved by the JPC. The rest in terms of the actual performance metrics, and there's different thinking, absolute, relative, combination of the 2. All of those, we have not come to a decision in terms of what we use. But what we decided was that we will have a maximum in terms of what the incentive comp could be, that the JPC is approved, and we get the boards to approve, and then we take it to the city council. That's kind of where we are. And specifically in terms of what was discussed and approved, we said we're going to have 3 positions: investment officers, the senior investment officers, and the CIO positions. They would be covered by the incentive comp. And the maximum would be 30% for IOs, 40% for the senior IOs, and 50% for the CIO. And this again used the 2 systems that we talked about, San Bernardino and Orange County, and I think this kind of puts us kind of in the middle of the range of those 2. So I think we have designed something which is kind of in the ballpark of what people who are actually doing are doing. And I think it's a step forward for us in terms of the things we're trying to do in terms of improving governance. So that's kind of a thinking. So at that point, if Drew, you, or Andrew have anything to say, I'll give you the floor before we go to discussion.
Yeah, sure. So per what Eshvar said, this will be a program. I think Orange County's, it's 3 or 4 pages long. That is yet to be fully fleshed out, but I think Eshvar's right. The JPC would like the board's support for these numbers since they are sort of the backbone of the program. I imagine our program will look a lot like Orange County. As Eshvar said, there aren't a lot of benchmarks. We'll probably, take best practice out there. Anything from you, Andrew?
Not at the moment. I think Eshwar covered pretty much the thought of the JPC and how we went through this process. Thanks.
Yeah. Javi, do you have anything to say?
Well, I was just going to make a comment that one of the reasons why San Bernardino's plan and Orange County's plan are highly relevant to San Jose's plan is that both of those plans have delegated, the boards have delegated substantial responsibility to their very mature and experienced investment office staff. And that's very similar to what this board has done over time and continues to do, as we've seen with the venture capital investments as well. So they're highly relevant in that respect. Many other systems are all over the map in California as to how much responsibility and with what constraints have been delegated to their investment office.
Well, and as you said, right, Harvey, the county delegated a lot to the board of Orange County, right? They're their own district. So all the way down. I'll go ahead and make the motion then. I move that the board endorse these 3 levels set by the JPC. Is there a second?
Second.
Great. Second by, motion by Lanza, second by Santos. Let's go around. Frank?
Can I make a quick comment?
Yeah, sure.
Just more procedural, just for people that weren't on the JPC. You know, if we approve this, this will go to City Council. We'll present this along with the salary ranges that we approved last month. And then it will get feedback from City Council. Hopefully City Council will approve it. They might be receptive, they might not be receptive. So just because we're approving it here, there still might be some work to go.
Right. Measure G gave us the right to hire and fire Roberto, but it didn't give us the absolute right to set his salary, and nor Prabhu's, nor the IOs underneath Prabhu. So good point. All right.
So one quick question. So are we approving the concept or are we approving some numbers?
I think we want to approve these numbers, and we will see the final detailed plan of the incentive competitions. August or September board meeting, do you know when we'd see a 2 or 3 page description of details of the plan?
Well, I think what will go to the city council is this, what we have here. But in terms of working out how we calculate what they get, may take longer. It may be that, but.
Yeah, well, I guess to the extent that these awards would be given out, when have they given? Late September, early October, or something? When does the pay raise come?
So I don't know. I think right now after the June meeting, the first meeting of council when they get back after July is August 8th.
No,
so
but I'm saying when would these checks actually get cut? Like early October? When does the pay raise kick in?
As of June 30th, they kick in the first pay period in October.
Yeah.
So it really depends. If you do establish an incentive compensation plan, it depends on the timeline. When you start measuring, and it's sometime after that. And this will be different than the regular salary because these are one-time paychecks.
Yeah, but they probably want the system synced because that's when we do the performance reviews. And I assume the incentive comp will partly be based on those Anyway, any more questions?
So I only see letters on this page, no numbers.
Which page?
What are we voting on?
Go and look in your agenda, Sunita. It's on the agenda item.
Oh, okay, got it. Thank you.
Yeah. That's a good point. Let me go ahead and repeat those. So the recommendation of the JPC, matching what San Bernardino and Orange County did, was to break it up into Chief Investment Officer, which is Prabhu, and then Senior Investment Officers and Regular Investment Officers. And the recommendation was a maximum incentive comp of 50% for the CIO, 40% for the senior IO, and 30% for the investment officer. And as Eshvar said, those all sit somewhere in between Orange County and San Bernardino. So there's a motion by Lanza, second by Santos on the table. Any further questions? Let's go on. Franco.
Aye.
Sunita.
Aye.
Andrew.
Aye.
David.
Aye.
Eshvar.
Aye.
Dick. Dave.
Aye.
Dave's not here, man. And then I'm Drew Lanza, I'm chairman. I vote aye as well. Good job, Eshvar. Eshvar, by the way, Eshvar has done a great job. That committee is definitely made up of cats, and Eshvar is the lead cat herder. It's actually really hard to do this because, as Eshvar said, there really is no reference point. We are San Jose. I guess, Laura, you'd probably agree. We're kind of out there, right? We're sort of leading the charge. So Eshvar's had to herd a group of cats through a very dark room. Good job, Eshvar. On to retirements. Great. We have a long list today. Bear with me. The service retirement of, we got 13 and 14. Brian S. Anderson, Police Lieutenant, Police Department, effective July 8th, 2023, with 25.28 years of service. Joe A. Favorito Jr., Fire Captain, Fire Department, effective July 6th, 2023, with 25.19 years of service. John M. Hutchings, Police Lieutenant, Police Department, effective May 13th, 2023, 32.05 years of service. Good for you, John, with reciprocity. Scott R. Johnson, Police Lieutenant, Police Department, effective July 2023, 27.3. We're losing a lot. All these people are 25 years. We're losing a lot. John Marfia, Police Sergeant, Police Department, effective July 2022, July 22nd, 2023, with 27.34 years of service. Albert C. Morales, Police Sergeant, Police Department, effective June 24th, 2023, 27.73 years of service with reciprocity. Edward R. Schroeder, Deputy Chief of Police, Police Department, effective June 10, 2023, 28.84 years of service. It's unusual to read a list this long with no one less than 25. Christopher M. Skiba or Seba, Police Department, Police Sergeant, Police Department, effective July 8, 2023, 26.84 years of service. Jared Tony, Police Officer, Police Department, effective July 22nd, 2023, 25.84 years of service. Doug T. Tron, Police Sergeant, Police Department, effective July 1st, 2023, 27.28 years of service. Michael Van Dalen, I've met him. Fire Captain, Fire Department, effective July 22nd, 2023, 26.27 years of service with reciprocity. There is finally the last one's 20. Darren Wallace, Battalion Chief, Fire Department, effective June 24th, 2023, 26.88 years of service. And Todd Wellman, Police Officer, Police Department, effective June 24, 2023, 20.03 years of service. We'll have a motion to approve. I have a motion by Santos. I have a second.
Second, Gardner.
I have a second by Gardner. Let's go around. Franco.
Aye.
Sunita.
Aye.
Andrew.
Aye.
David.
Aye.
Eshvar.
Aye.
Dick.
Yep.
Dave.
Aye.
I'm Jude Lanza. I say aye. Any of you guys want to make any comments?
Yeah, real quick. Thank you for your service. Stay healthy.
Gardner, same thing. Thank you for your service and have a good retirement.
Anything from you, Frank or Dave?
I'm Trustee Wilson. I worked with all these guys on the PD side. We're losing a lot of experience. 25 to 30 years, they've taken care of the last 25 to 30 years, they've taken care of the city.
Yeah, we thank you all, one and all, for your service. All right, let's do, we got 200 for vest. We have Phil M. Kraft, Police Officer, Police Department, effective June 22nd, 2023, 11.43 years of service. And Mark Hawk, Police Officer, Police Department, effective July 27, 2023, 16.26 years of service. Entertain a motion.
So moved.
Motion by Santos. Do I have a second?
Second, Gardner.
I have a second by Gardner. Around the clock we go. Franco.
Aye.
Sunita.
Aye.
Andrew.
Aye.
David.
Aye.
Eshvar.
Aye.
Dick.
Yep.
Dave.
Aye.
I'm Chair Lanza. I vote aye as well. We fortunately have a small death notification list. We'll read the names and they'll have a moment of silence. Notification of the death of William E. Anderson, police officer, retired November 14th, 1967. Well, at least he got to enjoy his retirement. Died May 4th, 2023, leaving no survivorship benefits. Notification of the death of Joseph N. Fowles, fire captain, retired January 31st, 2004, died April 3rd, 2023. Survivorship benefits to Mary Fowles, spouse, and the notification of the death of Peter R. Torres, fire engineer, retired September 12th, 2004, died March 29th, 2023. Survivorship benefits to Deborah Torres, spouse. We'll have a moment of silence. Great. And any you want to say anything about these, gents?
Oh, real quick, I didn't know the police officer Anderson, but I heard of him. But I can say that Captain Fowles and Engineer Torres, way too young. Excellent, excellent workers, and the best of their families.
Yeah. Anything, Andrew, Franco, Dave, anything?
For me, just condolences to the family.
Great. All right. Investment Committee, back to you, Eshvar.
We haven't had a meeting since.
Great, and because we're no longer under COVID restrictions, we have no minutes to receive and file. Sunita, Audit Committee.
Yeah, thank you. We had a joint audit committee meeting May 18th, I believe. The couple of updates from that. One is the last item on the city auditor report has been, staff has resolved and closed that from, and congratulations for resolving all that.
That was like 15 years ago.
I don't know what year.
I think it was 2008, wasn't it, Barbara? Yeah. Good. Great. Well, we have nothing if we don't have a lot of gumption, right?
The other item to update was there was a presentation by our internal auditor, Human, to the committee around an audit for procurement and contract oversight. The audit committee heard his concerns and his findings, and we are still deliberating on the report. And we will come back to the board in a couple of months after we have met again.
And that impacts Federated too, so we have to wait until we're in sync with them, right?
Yes.
And do they have a chair of their audit committee now? Is that vacant?
It is vacant.
It is vacant,
The last
so
meeting
yeah,
by Mike.
might be, do it right. Yeah,
So it's
do it
going to
right.
probably take a little time,
Yeah,
yes.
that's fine. And then you have the Macias Jenny, is that right, on your agenda?
Sorry?
Look at 7.2D. Didn't we do that last meeting?
Oh, yes.
Yeah. Did we do that last meeting?
Oh, yes,
No.
that's right. We heard
Okay.
from about their contract. So go ahead.
No, I was just going to say, so receive and file the minutes on 7.2B, but D, these are the brand new auditors that were hired, Mrs. Genie, and they presented their plan for the annual upcoming financial audit. And so the question for you boys, I think the committee is actually recommending approval of the audit plan.
Right, that was
board.
quick because we only approved hiring them last meeting. Any comments on the plans? It's pretty straightforward. If it's
Yeah,
a
pretty
plan.
straightforward.
Yeah.
Financial audit, it's,
MSC is great. I've worked with them for decades. Any questions on the audit plan? I'll entertain a motion to approve the audit plan. I got a motion by
Second.
Santos. I have a second by Sunita. Around we go. Franco.
Aye.
Sunita.
Aye.
Andrew.
Aye.
David.
Aye.
Eshvar.
Aye.
Dick. Dave.
Aye.
I'm Chair Lanza. I say aye, as well as Roberto said, make note of the fact that we received and filed the minutes of Feb 16. Franco, anything to report from governance?
Nothing to report. We have not met.
Dick, anything to report from disability?
Yes, we'll be meeting Monday at 10 o'clock at our office building on Metro and First. We have 4 applicants, and things seem to be going well. Thank you.
Great. And we note we'll receive and file the minutes of the Disability Committee from April 10th. Back to you one last time, Eshvar. Anything from JPC?
It's what we discussed last time and this time, the salary and the incentive comp.
Great. And we'll note that we receive and filed the minutes from April 3rd. Any public comment? Anything? Harvey, was there anything we forgot? No, I think we're good.
Well, I just wanted to make sure for the record, when we came out of closed session, that we noted for the record that there was no reportable action.
Yeah, I said that.
Okay.
Yeah, I did make that note. And we will report out next month. Some of it, the reports we're dealing with things we're negotiating, and we haven't quite signed off.
And I just wanted to remind all of you, this is your last board meeting of the fiscal year. July is dark, so we don't meet. Your next meeting will be your first Thursday, August. And Barbara, correct me if I'm mistaken, I think from now on, if not all, most of our meetings will go back to the wing room right next to the chair.
They're doing work. They're
They're doing
remodeling.
work. They're
Yeah,
remodeling,
cool.
doing
Yeah.
some work. So that's why we're in the city, the chambers. We appreciate the city council. We like this room as well. We're always willing and happy to meet here if we cannot meet in the
But
wing
the
room. in
echo
any
is a
way.
little spooky.
Yeah, but it makes my accent a little better. So
No, it's the bird. The bird
oh,
made
okay,
your
that's what it
accent.
is. All
What
right.
did you say his name was? Picasso? No.
Picasso, yeah.
I
Picasso
see.
is the
that
bird.
right?
That's right.
All right. Going
Thank you.
once, watch. This is great. Going once, going twice. We're adjourned. Thank you so much.